like that meme. We could have like the dip of the dip of the dippity dip. If things do, let's say, get cut in half, I imagine the large majority of these retail investors are going to run for the exits, sell at the bottom, or, sell when things are worse than they are now. And then they will be, unfortunately, the dumb money yet again.
I broke my rule for the 20th time, my cardinal rule, like don't sell the world's best companies, like because that's always what's cost me in the past. So I broke the rule again.
I don't mind not being right, but I want to make money. And this looks like a good stock.
You hear about the big winners, but the 99 people out of 100 that took big bets and lost, you don't hear about them because they're dead.
Would you rather make good decisions or make money?
Play the long game, bet on process.
For an advertising-free version of the show, check out patreon.com/Wall Street Wildlife. Hello and welcome to Wall Street Wildlife with Krzysztof and Luke. This week, is it more important to be right or to make money?
I like being right.
I like making money.
Boom.
Also, I've done a bunch of trading. I bought some puts on something I mentioned last week. I'm going to talk about that today. I also bought a stock, and my t-shirt might be a clue. And I've trimmed some stuff. So there's all sorts of things that have happened in the portfolio. I'm going to talk about that at the back of the episode.
Yeah, that's the first thing we got to discuss. What is this visual insult that you're bringing to our podcast?
Well, I'm just supporting my company. I'm wearing a SpaceX t-shirt, which I dug out. So actually, I dug it out of the closet. I haven't worn it for about a year because I had a really great catch up with an ex-colleague, Alexandra, this morning. And she is now a Singapore-based venture capitalist, and she specializes in the space segment. She's got quite an interesting Substack, and we'll talk about that more later because we're hoping to get her on the show to share some of her expertise on all things space, interesting investments in the private market and in the public market. So that's why I'm wearing the SpaceX t-shirt today.
Yeah, that'll be exciting. We didn't plan this, but it occurred to me that last thing we talked about were Tesla earnings. And I just want to say, like, how the market, like the whole thing between results and price and lack of correlation.
Yeah.
I thought the results were bad.
I thought they were terrible. Yeah.
And we got what I thought we were going to get is a bunch of future hopium.
Yeah.
But the results were bad enough that the price would actually drop significantly. And what's it done instead? It's up like 24%, 25%.
What, 25% since earnings? I didn't realize that much.
I think since, yeah. Don't quote me on that number a lot, but it's a lot. It's not like a little.
Yeah.
Okay. Like the short-termism of it doesn't, it makes sense because some fund wants to defend its position. It doesn't even matter like how it comes to be. It's just not rational.
Yeah,
is the point.
And I gave strong consideration to that one because I trimmed two things today that are overvalued in my portfolio, and I thought really hard, like, should I trim Tesla as well because it's overvalued, no argument, and the results were dog shit, like worse than I expected. But I can't bring myself to trimming it. Like, we're so close to auto taxi day, whatever it's called, robo taxi day. Like, I don't know, it just feels like the bad play trimming it right now.
I broke my rule for the 20th time, my cardinal rule, like don't sell the world's best companies, like because that's always what's cost me in the past. So I broke the rule again. I sold it because I want to allocate a little more into ASTS. Okay. So I had a definite reason for doing it, but I bet you it's going to bite me in the ass for the 20th time.
Yeah. And I know why you're adding to your ASTS. You're getting frisky. So, part of my disclosure at the back of the episode, I now am an ASTS shareholder. And I bought it in my real money portfolio, starter position. And I also bought it in my King of the Jungle portfolio, just, to sort of do honor there. But I only bought a small amount in King of the Jungle to respect the fact that this is your stock. But even that was like, you're like, shit, he doesn't want to catch my position. I've got to buy more.
That's right. I wanted to call you out on that for saying both. Thank you for being mostly noble in your approach and, honoring a gentleman's agreement of sorts, never spoken, never written down. We don't have any bylaws, but I appreciate your, call it, Yeah, nobility. I think nobility is the right word. You
Yeah,
could, there's all kinds of game-ish things we could do to kind of mess with the other guy.
yeah,
And at the same time, fuck you.
yeah. Well, look, hey,
Now I gotta buy all these extra shares to make up the difference
but like I
for
said at the top of the episode, Christoph, I don't mind not being right, but I want to make money, and this looks like a good stock. So there you go.
So you're right. I immediately had to buy an extra share to reduce the delta in how many shares
You
I
know what I
need to.
did do though, actually? So like I bought the same stock within like a minute deliberately on both my regular brokerage, like my actual investment account with the real money is, and I bought the same thing essentially, obviously much smaller amount, on my trading 212 brokerage, which is where I have my King of the Jungle portfolio. And I did that because I wanted to see, am I getting like substandard pricing on my trading 212 account? And I don't think I am. I think I was maybe skeptical about them not being a proper broker and maybe giving me like dubious spreads and things like that. But no, I mean, I've read that they offer best execution, which you have to in the UK. It's like a legal requirement. But I thought maybe they got some dodge or something. But I got like essentially the same price on different volumes on these two platforms. And like my part of my real brokerage is interactive broker, like big serious broker, and like I know I'm getting good like market pricing there. So yeah, actually, maybe I'm wrong to be skeptical about my little what I called my like Mickey Mouse brokerage trading 212. Maybe it's totally legit.
Cool. Awesome. Hey, can I backtrack and say one more thing about ASTS?
Yeah.
I didn't buy that share just out of gamesmanship. I think it's worth noting. Big news item happened. I think it was over the weekend. My time warp right now is a little weird because my professional stuff. But the what's it called? The head of the SEC and the senator from Texas visited the facilities down in Texas.
Yep.
And this is all in part of something that's being tweeted out as the Golden Dome. Basically, US defense systems just allocated many billions of dollars to the industry. And so the head basically, why do senior government officials visit your facility in the middle of nowhere, Texas? You know what I mean? And it's basically setting up ASTS to seemingly jump through all the necessary future hoops, regulatory hoops, to get potentially massive government contracts. That's where the big money is. Retail investors probably think of it as, when it goes commercial, direct to phone. And yeah, that's a huge part of the thesis. But the hundreds of billions of dollars in contracts, that's government spending. And it seems like ASTS has the lead there. And I just want as much exposure to it as is reasonable in this moment before, actual news breaks, because probabilistically, I think it's now in favor of happening. And it could happen one of those things like overnight, basically. We don't know. No one knows. So,
And I'm like, I bought a just over a 0.5% allocation in my portfolio, my real money portfolio, which is I use that for like getting a foot in the door, getting started. And it's kind of based on relatively minimal due diligence. If I just like the look of something, and I actually probably read more about ASTS over the weekend prior to that buy over like Wednesday, Thursday, than I would normally do for like a starter position like that. But there are still some like material execution risks with this company, right? They've got like their big satellite, the huge one that unfolds to like 15 meters by 15 meters. Like they haven't put that in orbit yet. So there's like seriously unproven technology. And like the whole thing could come like crashing down. I mean, literally the satellite could, but like the business model could come collapsing down still.
Yes, there's no disagreement there, though. I don't know what the probabilities of a meltdown like that would be. So,
what I liked most about them wasn't so much the technology; it was like the commercial model. You've been bleating on about that. What noises do monkeys make? Like yapping about
screeching. I screech.
Screeching.
When I get excited, I screech.
There we go. You've been screeching about their commercial model, but you're right. Like that makes a lot of sense. B to B to C, essentially. have contracted with like over 40 of the world's biggest mobile network operators, including Vodafone, which is one of the biggest in the UK and Europe, AT&T in the US, and like a whole bunch of others all around the world. And like essentially those guys are selling the service for them. So that makes a ton of sense. And also like Google and Vodafone and several others now own like a relative material stake in ASTS. So even if like, I think this stuff does get commoditized at some point. And I do think like, we don't know what SpaceX's V3, like the next generation of hardware looks like. They haven't announced any specs, and it's going to be like materially more powerful, like terabits per second compared to hundreds of gigabits per second on the current generation of hardware. But they haven't proven it yet because they need like Starship, like their bigger orbital capacity. They need that to put a thing in orbit, and that's not actually delivering payloads other than test payloads yet. But once they put that up, like they could be in competition with ASTS. I think the commercial model protects ASTS to a large extent, and the partnership protects them. But at some point, like SpaceX probably will have like some parity technology where they're able to create like a regular mobile phone cell that a regular mobile phone handset can talk to, even though you're saying, screeching ASTS technology is better because it's more focused. Yeah, sure. But we don't know what's coming. And at some point, maybe it just becomes commoditized, and like Vodafone and everybody else just buy capacity from these different providers.
My understanding is that it's not that simple because of patents and because of regulatory approvals, because signals mess with all kinds of stuff. And whatever technology lead you're talking about in years to catch up. And therefore, once a big player establishes a kind of monopoly and has all the backing of all the players, why there will be switchover gets complicated. So there's that.
I understand what you're saying, but like if I were Vodafone and I did this commercial deal and I bought a stake in ASTS, like these guys still have unproven technology, and Vodafone would be freaking insane if they had some sort of exclusivity like locked into the contract. That might be the spirit of the relationship, but if ASTS can't execute for some reason, then like you would think Vodafone will be able to walk away from that, maybe write off their investment and use like another partner. And they own the spectrum in each of their markets. So they would just essentially like allow SpaceX or whoever else to use the same spectrum. So, you're right. There are hurdles and there's an technology advantage, but I don't think anything is off the table in terms of who could be the ultimate winner.
Well, that's the other point I want to make. One of the reasons I'm as comfortable making this an ever increasingly large investment is because we're talking about all of space here. And it seems like one of those things where a monopoly is not going to be the end result.
Yeah.
And even if that's the case, because the applications are so, we'll hear more about this from your friend, but it's like a whole new frontier. Even something as 50, something like 50-50 or 60-40 or 70-30 are going to be massive, massive winners from these valuations. So I'm not even concerned about that.
Yeah. And at a $5 billion odd valuation, I think ASTS is a great risk-based reward bet. I'm with you.
Yeah. So welcome aboard, Badger, and best of luck to us both now.
Yeah. Good
Took you a while, but we got you. Good.
Hey, before we get on to our headline topic about being right versus making money, quite an interesting other business model innovation in the UK I just saw announced. So I buy my electricity and gas from a company called Octopus. And it's like the way the UK, I'm not going to be an expert here, I'll probably misstate this, but essentially the way like the UK market works is if you buy gas or electricity, essentially like there's different providers. No one, like they don't come and change like the pipes coming to the house, but you're buying like wholesale from different people. And Octopus have always had a reputation for like being greener, using like green sources of power, and to the extent you can, like gas by, I don't know, planting trees or however they kind of offset the thing. So I buy my electricity from Octopus, and so does my brother. And so I told him the other day, they have just announced a unlimited mileage for electric vehicles. So for £30 a month, which is about 40 US dollars, now you get unlimited charging of your electric car, and you have to have like a particular like charger, because then it talks to the network and they know you're not like, just like charging up your house and your batteries and making cups of tea in the middle of the night. And it only operates during like periods of low network capacity, because it makes sense, right? You want to sell your power when you've got excess power, and it says you having to store it, and it gets complicated. So yeah, like great innovation for consumers. Like they're piloting it in the UK market, but for £30 a month, you can do that deal for a year at the moment. And essentially now, if you've got like an electric car, that's it, like free.
Cool.
Yeah.
That's good progress. I love seeing electric cars just becoming more mainstream. And one bit of note too, speaking of electric cars, my good buddy sold his Tesla, said won't ever go back, and bought a Rivian and let me play with it a little bit, and it's pretty cool.
Okay.
So my earlier thesis that companies like Rivian and Lucid, like that they're in trouble because they're awful financials. I think the political stuff is definitely shifting, and electric cars, I'm just seeing more of them everywhere. And with things, I don't know. I like where that's going, which reminds me that some of the really beaten down stocks, like for example, Wolfspeed and Air, AEHR, those companies might be good for us to look at, because that kind of pit of despair around electric vehicle adoption might be at its lowest point, kind of starting to trend up.
Yeah.
And that's a good moment to buy beaten down stocks. So
yeah, cool. It's interesting actually. That'll bring me on to my Safari stock for today, but we'll save that to the back. But like some of these companies are total frauds though. Like, you said Rivian, like they're looking rock solid actually. Like they've got real production vehicles that they're selling, I think at a loss, because they're still scaling, I think. So I don't know if the business model's quite worked out yet. But like Nikola, right? They faked it with their electric truck. And then I think the founder, didn't he do jail time for fraud, I think?
don't know, but not great if he did.
Yeah.
Okay. So the topic du jour is a post I came across on X that I really, really loved. And I think you and I could go nuts on this all day long, because it spoke near and dear to my heart for lots of reasons. His name is Kevin Mack, and he teaches finance over at Stanford. And in general, I just really enjoy, he's very thoughtful and critical on both sides, just doesn't do rah-rah, quantifies. He's like a poker player that does mathematical probabilities and multiplications of what's the likeliness of things coming out, not just based on feeling. Anyway, his main question is, why is there a disconnect between poker and professional investing? Like, what's the difference between those two views? And he came up with a couple of main ideas. Let's run through them. The first one is that in investing, timeframes are longer. And so in poker, basically, when you're good, you just make a lot of decisions very quickly, and you get to find out whether you're playing well or not, because you'll have 1,000 decisions in the night or something. In investing, you can make a decision today and not know until 3 years later, right? And there's this view that judgment in the financial world is based on outcomes. So it is true. I mean, this is why you have such wild price fluctuations that diverge often from fundamentals, because the people controlling the money, they have to show a profit at the end of a quarter. If they don't show a profit, their jobs are at stake. So they're going to manipulate things not based on process, but did you make money or did you lose money? So that's short-termism.
Yeah. And by the way, like I've said this, so I'm blue in the face. This is why, like chasing, like getting like an active fund manager or having like a financial advisor, like you're asking for trouble, because their incentives are not aligned with your incentives. Like if you're not going to manage your own money and pick your own stocks where you only have to convince yourself that if at the end of a quarter you're down, like you still know what you're doing. If you're gonna go like hands off, don't give the decision maker to somebody else. Put your money in a passive index tracker where there's no human like having to show results. It's just the market.
In poker, you have ego and incentives to win big. So also in the short-term version of investing. And then there's, in other words, where the process is secondary. That's the repeated point. And fourth, survivorship bias distorts everything. You talk about that quite a bit,
Yep.
right? Sure, you hear about the big winners, but the 99 people out of 100 that took big bets and lost, you don't hear about them because they're dead.
Yep.
So he summarizes that gap as the game. The game is to maximize variance during your evaluation window and hope that luck lands in your favor. So, what does that mean in simple speak? Evaluation window is when you have this artificial frame by which you're being judged. So, for big portfolio managers, that's, let's say, quarterly, or even companies, right? You have to pull levers to make your results appear a certain way in the short term. And within a certain window, in a sense, to maximize variance means the bigger a bet you take, the more likely you could appear like a genius if you're right. And so that's the sort of short-term game versus what we want to preach, or would try to preach, is it's almost everything we just talked about is resulting. Annie Duke talks about that. We want to stick to the process that's correct because over a longer period of time, it's the process that's going to win. And so he then comes up with some rules for himself that he wants to make sure he applies to his own investing that gets away from the, call it, short-termism. And I think there's some nuance in here if you want to talk about those points as well.
And just before we do, like, what I haven't really read beyond the link you sent me. Like, is he he said he's now a professional investor, but he's like a portfolio manager for other people's money?
Right. He's also doing that too.
Okay.
And that's one of his points.
Right. Okay.
That to pick up that one, that when you start managing other people's money, you have to show gains.
Mhm.
So it's not theoretical. But he also says, and I think this is wise, and this speaks to our King of the Jungle portfolio. I think why it's a feature of what we do is because we're putting in our own money in our research. So we're not just coming up with wild bets that have no, that then therefore don't impact us and our show, right? Because we're responsible for our decisions. We have to talk about them. So he says that he also has 95% of his liquid wealth in the very things that he recommends his own funds to buy. So I think that's good, skin in the game kind of stuff. And so he says this is interesting. Given this goal of being aligned with your investors and being willing to take big bets, but not so many that you will then destroy yourself, he says, given these goals, how should a more aligned process look? One, pick an investing strategy that involves as many bets as possible with short resolution time. Be careful not to fool myself into thinking many correlated bets count as multiple n. I want my alpha to converge as quickly as possible. So this is the interesting point. That's like, take as many bets as possible with a short resolution time. So that's sort of counter, it feels like to me, to pick an investment and you have to wait for a long time before you find out if you're right or wrong or not. So to me, basically, I'm reading this as a happy middle between pure short-term gambling, where you just find the bet with the highest alpha, meaning the highest, kind of like gambling, lottery picks, right? And on the other hand, there's some bets that are so long, so far out, and so unknown that it'll take 3 to 5 years before you even know you're right. And his approach is maybe like, kind of like, I don't know if this is right, like a poker player that finds a table with less skilled players and then just tries to play as many hands as possible, knowing that his skill set, that the way he's playing is correct, but he wants to increase the bets, so to speak. So he'll know he's right quicker.
That makes sense, but I don't know how he does that. Like there's okay, so you do a bit this to an extent. Like you try and look for companies that have some sort of inflection point or like important thing coming up. And if you are like, we don't know if you're truly generating alpha because you haven't done the freaking analysis. And I'll keep nagging you to, give me some stats, Krzysztof. Show me how you're one of the world's greatest investors. We don't have the history to tell us that. So if you assume that you're a market beating investor, then that makes sense. And that this guy's predicated on that. Like if I have to assume I'm delivering, like yielding alpha, otherwise why am I even doing this? So if he does, and not many people do, like genuinely, there aren't many people who can beat the market. That's what generating alpha means, essentially. You're making better decisions than most of the time. But yeah, if your decisions can pay off sooner, you'll validate that, and you'll have an important, as a fund manager to other people, not only do you get like the satisfaction yourself, but you then have some evidence. Because it's quite hard to run even like a fund of some sort, any kind of fund, in the first couple of years, because you've got no track record, you've got no way to sort of prove to your investors, and so then it's hard to raise capital. So you want like wins as early as possible.
Yeah, absolutely. And I would say that's what the role that our King of the Jungle portfolio serves. In this case specifically, this is why I found this so interesting, because I think I feel quite aligned with what he's talking about. I think I'm doing, to a large extent, what he's, that kind of middle ground that I sense him talking about. The majority of my bets in King of the Jungle are right now, I kind of, it feels like they are high alpha possibilities that still need some time to play out. They have not yet played out, besides EOS, meaning from the lows at which I bought them. But I'm not going to need 3 years to find out whether I was right or not. But so right now I don't even know what the total portfolio is in terms of gains.
Like he's given himself a difficult challenge, and maybe it's one he has to do. I sort of get his logic, and like if you listen to this conversation and you're kind of confused, go, like the link is in the show notes, go read the thing yourself and then come back and unpause and carry on with the conversation with us. I feel like if this is his strategy to make like short-term bets, in some ways he's like artificially hampering himself, because like there are significant, very good investments, but with a very long time horizon. So is it that he's going to bias to short-term things a little bit, or he's just going to exclusively focus on those? Because if he does, like he's missing a whole chunk of the market that could be very interesting.
I think a lot has to do with how we're defining short-term versus long-term, because in the abstract, that's like he's not taking positions in with like an expected 3 to 6 month outcome, but neither, I think, is he taking positions. I don't think he holds many companies that are, the slow, steady, and true, the kinds that you hold. So it'd be a good question to maybe ask him if we reach out, but I'm assuming it's something like a year-ish, 2-year-ish possible outcomes is what he's thinking of as his time frame. I mean, in the end, he ends the thread by saying, accept the leap, play the long game, bet on process. So this is look, at the end of it, I came away with this feeling that he's thinking like a poker player. He does want us thinking process first, but like a poker player, if you know you're a good one, you want to take a lot of bets quickly, because it's just a matter of time before you see the payoff. I think that's the main point, and that's what's resonating with me. if, of course, you know what you're doing and you can find the, real alpha via research well. And that's one of his other points. He says this area of having legitimate alpha beating, call it research skills, is rare, and he thinks he has it.
So let me pick up on two other points that I do want to critique in this. We sort of skipped over them a little bit because I think two of them go hand in hand. So in his like 5 things that he's going to do, like his structure, number 3 is actively communicate with outside investors, ensure there's good alignment between what they want and what I'm planning to do. And then number 5 is have a cost structure in place that can withstand capital outflows that inevitably will happen. Like if this guy ain't managed a fund before, he might be underestimating how difficult number 3 is, the communication. And when things go bad, if they go really bad, number 5 will spank his ass very, very fast. Like, what do I mean by that? Essentially, let's say we are going into tariff doomsday, right? Who knows if starting a fund today, if this is going to be like the best of times or the worst of times to start having like significant new long positions, because we might be going into like a multi-year serious drawdown, recession, possibly stagflation. Like we talked about that in previous episodes. Ain't saying it's going to happen, but it could happen. And if he does, even his short bets, whatever, like even if he has alpha, he's probably going to get chewed up by the market, because we're all going to get chewed up by the market in that kind of scenario. And then his investors, like, good luck communicating that with your retail investors. Might be all right if it's like, like friends and family money, although maybe they're harder, like Christmas and Thanksgiving is going to be a pretty tough conversation. But like if he's managing outside money and everyone's like, well, the world is falling apart, what are you doing, Kevin? And if his answer is, well, we're staying in good quality things and these short bets, and here's my thesis, people ain't going to buy that still when they're hemorrhaging their balance on their investment, and they're going to pull the money out. Like they'll write you off as someone who's failed. Whereas it may not be your decisions. It might just be, the unlucky freaking timing of starting a fund right now when we might be going into like some form of doomsday. This is why I really, even with the best, if this guy is the greatest fund manager in the world, this game is, it's not, I was about to say it's rigged. It's not, it is rigged, but for different, that's outside the scope of what we're talking about. But it just doesn't work in my mind, the game of managing other people's money. I'm adamant about that. And I think Kevin's going to learn a hard lesson if he's unlucky.
Yeah, and right. We poker players know, unfortunately, that in the short term, luck rules.
Yeah.
So that's the other thing. You have to survive long enough. He says this somewhere, to his credit, because I really think he's he's one of these good faith actors in the space. Luck in the short term, you have to survive.
Yep.
And that's kind of priority number 1. So it's a tightrope act between trying to squeeze as much alpha as you can with some, call it, that I'm thinking of it as middle short-termish bets at rapid pace, measured with, but at the same time you can't explode.
Yeah.
And it's a death spiral if you do.
Yeah. Good luck to him. Good luck to him. I've not seen his account before. I'll give him a follow. It'll be interesting to see what's actually in his portfolio. I don't know if that's public somewhere.
It is. Actually, it's not, but I know he's an ASTS investor.
Okay.
And but he's critical. But this is good. He's critical of the rah-rah stuff.
Okay.
So you'll find it valuable for that.
Okay.
Yeah.
All right. Well, we'll post a link to his Twitter on the show notes anyway. Check it out. Very good. I've got a related news story, which I think does tie into your. Oh, did we answer that question actually? Because you've posed a question up front. Would you rather make good decisions or make money? Like, where do you sit on that now?
I'd like to make good decisions because that's going to make me more money, as long as I have the right expectations and timing framework. So I'm betting on decision making.
Oh, but isn't that like that's not the point Kevin's making? Like, I know obviously if you make bad decisions, they're probably going to catch up with you. But part of his point, or my interpretation of it, was like you don't, like, well, you said in the intro, you don't know if the decisions are good until much further down the track, and you'll only make like a handful of material decisions in your whole life as an investor compared to being a poker player. So actually, in my mind, the more important thing is make money.
So no, he diverges from that view. He says that's the cynical view.
Okay, all right.
Because that's the game that's rigged with survivorship bias. In the end, he's saying play the long game, bet on the process.
Okay.
But there's a way of doing it that I think it's not just pure long-termism that takes many years to resolve. This is where your skills at finding alpha generating situations come into play.
Yeah. Okay. Well, they go hand in hand. Obviously, you don't want to make bad decisions, and you do want to make money. Ideally, get both.
Right. You just have to survive. You have to balance enough of them to survive.
Yeah. Fair enough. Fair enough. So anyway, I caught up with a interesting article on the Wall Street Journal. I don't have a chance to read this before we connected today. I'm just going to read a couple of excerpts from it. Like, essentially, market chaos right now, and professional investors are running for the exits, like selling stuff, taking like short positions and hedging heavily. Individual investors, like supposedly the dumb money, like we talked about dumb money many months ago on the back of that quite hilarious movie, like individual investors are holding tight and actually adding to their positions. So some stats from the article: so far this year, so first like 4 months 2025, hedge funds have sold over $1 trillion more shares than they've purchased, while individual investors have bought $50 billion more in net purchases. So kind of everyone's operating in a different direction. And so what is going on, right? First, so this is kind of the point of this article, because it leaves it a little bit open-ended. The article implies, perhaps somewhat naively, that the institutional investors are the dumb money because they're selling, and the retail investors are like following good principles and hanging on and buying the dip. And like, so that is like, at a surface level, that is true. And if those individual investors could consistently do that through the possible doomsday that might be coming or might not be, no idea, then that works. Like, that's what I've done in the last couple of big corrections. And right now, like, I'm very seriously hedged with a big old cash position. And I'm fairly confident I'm not going to like panic sell if my portfolio gets cut in half, let's say, over the next 6 months to a year. But these guys, like the retail investors, they might look smart right now buying the dip, but maybe this ain't the dip. Like that meme, we could have like the dip of the dip of the dippity dip. If things do, let's say, get cut in half, like I imagine the large majority of these retail investors are going to run for the exits, sell at the bottom, or, you know, sell when things are worse than they are now. And then they will be, unfortunately, the dumb money yet again.
You know what my TLDR from hearing you talk just now is?
Yeah.
No one knows.
Yeah.
Neither the professionals nor the retail investors know what's around the corner because of the chaos in the world right now. And one side looks smart, the other side looks dumb. And whether that will turn out to be true is in this moment impossible to know.
Yep.
Though I suppose statistically, I don't know if this is a right way of thinking about this. The people with the large and I was gonna say I like instinctively want to side with the big funds selling as the smart money, and that they're more likely to be right because they actually control the game. You know, if a big, you know, like they could make the price go down if they want.
Yeah.
But for short-termism purposes, I don't think that's necessarily true. And if there's like this massive reversal, because we know, side note, we know at this point that Trump's style is that kind of art of the deal thing, where he's just kind of forcing issues onto the table. And that huge drop that we had with the big reverse now signals to me that the world might not be, on the verge of collapse. It's just more that it had to adapt to the kind of negotiation tactic that Trump is known for, and that the actual drawdown has been relatively small compared to the chaos that we just experienced.
Yep.
So I'm kind of cautiously optimistic, might be the phrase, around staying the course, letting the turbulence kind of make its way through the system, and that in the end, the big funds that were selling out of panic were more likely in this moment to have been wrong.
Yeah, I don't know if, yeah, you're right. Like, I don't know if you could point at any group right now where we don't know and say anyone is right or wrong. Everyone has like different objectives and different strategies and like different regulations and things that apply to them. And what's right for one group might be wrong for the other group. Like, if you're a retail investor and if you're clinging on, this is probably the most important part of the takeaway. Like, right now, that's looking like a good strategy, but you've got to stick to that strategy. Like, if things go really, really bad, then if you're in a position to keep like dollar cost averaging on the way down, just keep doing that. I mean, dollar cost average on the way down, on the way up, just keep doing it for like the next 30, 40 years, and you're going to be great. You're in a good situation. But things could get very scary before they get consistently better. And so
Yeah.
be ready for that.
And to that note, something you mentioned previous podcast that I want to reiterate, the tariff shocks that we know are coming in some segments are not yet being felt by the general population. So when all of a sudden, I don't know if it's going to be a month from now or 2 months from now or weeks, when you go to the store to buy something and it's 70% more expensive or whatever the number is going to be, and your eyes pop out of your head, and people are going to panic, like there's probably, I'm assuming, more seismic level kind of shocks that we can expect because of these delays. Just be prepared for that. No one's out of the woods yet.
Yeah.
This is all unfolding, but yes, over the long term, know your companies and then just continue buying more shares at better and better value points. Like, that's the playbook. That's our playbook.
Yeah, totally. And like the timeless wisdom of make sure you're not investing money you might need in the next 5 years. Like now, like maybe a lot of people, if things go bad, a lot of people are going to lose their jobs because companies in these like highly volatile if we go into like inflation, everything gets more expensive. Some goods you maybe see on the supermarket shelf today, you just may not see them. You can't buy certain things. So you've got to be flexible perhaps with your shopping basket. And unfortunately, a lot of people are going to lose their livelihood because companies are having to do the same thing. Companies are going to have to economize, cut costs. And the biggest cost base for most companies in most industries is like the human workforce. So like a ton of people are going to lose their job. And if you're impacted by that, maybe you want to increase your emergency fund or something right now while you're getting paid, and probably don't invest all of that. Like maybe extend your emergency fund up to, I don't know, an extra couple of months just to give yourself like a little bit of a buffer. One of my friends has got a great job, just, perfect for his skill set, I heard over the weekend, but he'd been out of work for over 400 days, like coming up for a year and a half, trying to find a job that like kind of, lit him up around the idea and stuff. So like, that's great, but it was a struggle. It's like, it's hard to, it's just a tough market right now. Like unemployment is almost at all-time lows. And there's a ton of jobs out there, but unemployment could be rising.
Wall Street Wildlife is brought to you by the Chit Chat Stocks podcast. My name is Ryan.
And my name is Brett.
And we're the hosts of the show.
On Chit Chat Stocks, we are constantly researching new stocks from high flyers to undiscovered small caps, diving deep into business models, debating competitive advantages, dissecting valuations, and we have a fun time while doing it.
Supercharge your investing research and start listening to the podcast today. You can follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts. Follow the show so you never miss an episode. That is the Chit Chat Stocks podcast.
With the first of the month coming up in just a couple of days, and our monthly infusion of 200 bananas into our portfolios, I've noticed it's so tempting to buy more shares immediately for me because of the values I already see, versus that feeling that 2 days out the market's going to drop and I could have had them, for much shorter. But that's market timing stuff. We've talked about that forever. But it's an interesting, if you repeat the process over a year, I kind of feel, and you just do the same thing consistently, you add consistently, I kind of think the times where you bought because you have a good reason versus if you had waited and could have gotten it cheaper, or maybe you wait and it's more expensive, it all kind of statistically tends to wash out probably. So you just, I don't know, you don't think too hard and add what you can.
And like what I'm doing right now. So I went for a couple of months where I was just building up my cash allocation, got to like 25% in January, did nothing for a couple of months. I mentioned on last week's podcast, I then started buying very tentatively. So I bought like a small stake in Novo Nordisk. I just mentioned I bought ASTS a few days ago. Well, I'm back down to like 22% cash. I want to get that back up again. So I trimmed two pretty overvalued holdings today. So I'll declare that on the podcast. I have trimmed my position in CrowdStrike and also my position in Palantir. Now, I still like both of these companies. I still have, like in my real money portfolio, I've got a material exposure to both of these, but I've taken CrowdStrike down from like I think it was like a nearly a 6% allocation. I've cut it down to about a 5% allocation. And Palantir, I've taken down from like a 2.8% down to about a 2.2% allocation. So I've kind of directionally trimmed about like a quarter or something off of both these holdings because the valuations are still like a bit whack.
I think that's smart. I really think that's smart. And I don't think it's market timing. I think as long as you have other places to put it and cash as a position, that framework, you might be wrong, but you're not selling out. I like that little nips and tucks here and there strategy. So I'm glad you're doing that.
Yeah, like it's definitely, we always see like these black and white positions when people talk about stocks on Twitter and places like, oh, I'm like all in, buy the farm, chase whatever it is, like load up the truck, or I've sold it all. Like investing decisions should rarely be like that unless something is fundamentally broken in the thesis, when it's correct to sell it all and maybe short it if you really believe that. Like nips and tucks, as you said, like add a little bit when the valuation seems reasonable and maybe trim a bit off when the valuation seems stretched. Like that's served me pretty well over the last, I've probably been doing that more actively since I became a professional investor. So the last 5 years or so.
Yeah. Awesome.
Yeah. I have two stocks I'm going to buy, but I'll save those for next week's podcast because I've got quite an exciting thing in the diary tomorrow morning, but I'll talk about that next week and hopefully have some photos to share.
Oh, the intrigue. Yeah. Speaking of nips and tucks, can I talk about our Safari stock, my Safari stock for the week?
Let's do it.
This is courtesy of one of our Patreons that said, hey, look into this company. And you punted it over to me because it's a tiny med tech company. And on initial glance, I was like, hell no. But I'll save my conclusion for the very end. The company is called MicroBot Medical, ticker MBOT. It's a tiny robotics company that's trying to revolutionize the endovascular surgery world, which means that when surgeons try to clean up your heart and your veins and arteries, basically to unclog them. That's more or less the point, right? You need to usually open up the body, and it's a big thing. This company, if you think of it, they create this little robot that allows the surgeon to enter into an artery, let's say through the leg, and then the little mechanical snake thing kind of moves up through the artery and gets to where it needs to go. The big innovation here is that these little systems called the Liberty are tiny. They're small little, think of a Nintendo Switch, like little, almost like a game console. And they're kind of shockingly one-time use. And that has to do with basically the huge demands on remaining sterile. So big, the current state of the art is like big hunking robots that hospitals buy for lots and lots of money. You're quite familiar with these kinds of robots, the Da Vinci systems from Intuitive Surgical, right?
Yeah.
These guys are saying, no, we're gonna sell you one-time little game switches, you get the job done, and you don't have to worry about sterility stuff. So that's kind of the product. They recently had good reports in terms of how effective this tool is, so that's good. And basically, they aim to be cheap and kind of more simple version, and it's a big market. However, however, it's a lottery ticket because it has no cash. They have $5 million on the balance sheet. They're going to probably very likely need more massive dilution. And one of our patrons said they were already FDA approved. That's not true. I think he then said, "Oh yeah, sorry, I got that wrong." But there's good and bad news here. They filed for, I think it's something called a 501k, which is kind of one of these FDI approval things that is the one you want to file for because it's more likely to be fulfilled quicker. Because they're basically saying we're not inventing a brand new thing, we're just making something that exists kind of better. So it's not like a new medicine that has to go through all kind of clinical trials, which takes years and years and years. So the good news is that they're expecting the result from this filing sometime in June. Let's call it June, right? If they get this approved, then all of the dilution stuff kind of becomes less of an issue, and now would be a great entry point. If they don't get this approval, then the delay of actual FDA approval will be more, months and months away. And now it's a bad investment from this moment because of the dilution that's coming up. So in the end, what you have is a lottery ticket on a tiny company. It's under 100 million market cap at the moment, which is usually even too small for me, for a brand new company that I know nothing about other than this initial DD. So it's just one of those, it's a lottery ticket. It's a lottery ticket. But here's the sort of surprise kicker, and I already maybe gave away my view. This is maybe more than this seems to me like a future potential competitor to your top holding Intuitive Surgical. Because and you're the expert here, so you could tell me, in which way I'm completely wrong. But if, say, things go best case scenario gangbusters for these guys, right? Then they're basically saying we can get these little devices into surgeons' hands for cheaper, quicker. The upfront cost capital to hospitals is much less. And if they basically do as good a job, and this is where I know nothing about, right? But if doctors like them, then I think it's fair to say they're playing in the same sphere as Intuitive Surgical. And that's why I ended up wanting to talk to you about this for the Safari stock, because regardless of call it being a viable investment in this moment, people like you who have a large position in Intuitive Surgical should at the very least know about them and follow, their journey, especially if it's successful and they start getting the FDA approvals. Then who knows, right? I don't know how it's going to unfold, but it's worth knowing about. So my TLDR is, I don't know if this is going to surprise you, but I'm actually going to buy one solid share for $2.60 to add it to my portfolio as one of those things. I'm like, oh yeah, there's catalysts in the near future. They have momentum. I cannot take a large position in any stretch, but I definitely want to keep them in my, watch list radar. So $2.60 of bananas are going into Monkey's portfolio to MicroBot.
All right. Good luck. Yeah, I don't know. I haven't read too much about them apart from knowing it was probably more you than me. I sort of cringed at the idea they could be a competitor to Intuitive Surgical just because like those guys have a 30-year track record. They're on like the 5th major iteration of their hardware. Like it's a material job to catch up, but they might disintermediate, or they might be better at a very specific kind of thing, which might not be surgery. It might be, these sort of more difficult, non-invasive, investigative, or intravascular things in particular.
Yeah, of course. No, but this is an important point. You're starting from a Intuitive Surgical is your baby.
Sure.
So of course, and you have more knowledge about it than most of your other companies. So you get that point. But I think as investors, it's just wise to say, oh, there's this tiny little, startup, odds are against it, but they do have promise. So if nothing else, worth just keeping up to date on for Intuitive Surgical's sake, so to speak. Because, what if they are successful, then maybe the future returns, maybe they start cutting into the pie a little bit. And so future returns for Intuitive Surgical diminish by whatever percentage points. It's not like it would make it a bad investment, but, you just widen the circle.
Totally. Yeah, it's good. And like I don't focus on any one particular sector, but I think it can be powerful to become like an expert in a particular domain, and then just know everything about that, and you can probably make better quality decisions in that area. So, if you want to be like a medical technology expert, I'm not, then you might want to do like a whole bunch of research on all these little upstarts, and you might have a better insight than me on which ones have a right to win and grow and be successful in their niche and which ones don't. So
and 2 more points. The financials for MBOT, that's courtesy of FinChat, which is one of our supporters for the show. That's my go-to platform where I see the overview of the financials, which obviously here pre-revenue are not great. And the other point I want to reemphasize is this is a Patreon recommendation. So patreon.com/Wall Street Wildlife. And this is exactly why a small little community of investors working together to, put ideas forward every so often, maybe this will be a 10x investment in 5 years. Who knows? And it's we really appreciate our patrons and how that's unfolding. So check us out if you haven't yet.
All right. Very good. Very good. I got a Safari stop for us as well this week. Should we do that?
Tell us.
Before I get into it, so we talked about autonomous vehicles earlier, and that I've always been interested in autonomous trucking, like freight. And I looked fairly hard at a company called Too Simple about a year and a half ago, and then they've just like gone to zero. Like they're dead in the water. Like no one's really looking like they have a solid approach to it. But anyway, let me Safari stock a company that is another one of these like startups trying to solve autonomous trucking. So Aurora Innovation, ticker AUR, and they specialize in developing and deploying autonomous driving solutions. They haven't really deployed any solutions just yet, but essentially their plan is to put driverless, the big 16-wheelers, like big trucks, onto the roads. And the thesis makes a ton of sense because having humans in the driving seat of trucks is expensive, adds a lot of inefficiency for very good reasons. Drivers are only allowed to drive a certain number of hours a day, and so they have like various devices to make sure they don't kind of breach that. Because you fall asleep, you can do a ton of damage in a big truck compared to like a car or a motorcycle. But no one's really solved it just yet. So Aurora Innovation, and I think this is really timely because they have said as recently as like a month ago, in April 2025, so like in the next couple of days, I'm not sure I buy it, they're going to launch their autonomous driving solution for the like a particular lane of like a fleet from Houston to Dallas. So it's not far from your neighborhood. And so they will be running like autonomous vehicles in Texas, they claim. Now, if you dig behind the headline a tiny bit, it's a little bit thin. So I think they've sort of pared back their announcement to they're planning to get 10 trucks on the road, one of which is autonomous. So like a bunch of smoke and mirrors, one autonomous vehicle by April. I've not seen in the news when I looked again this morning. They've only got like 2 or 3 days of the month left. So I don't know if they do something artificial to try and hit that date or not. I think the model makes sense because they're using NVIDIA Drive 4 system on a chip and their NVIDIA's Drive OS. So I think that means they don't need to solve autonomy themselves, but it's a lot more complex, like navigating a massive vehicle like that with so much inertia compared to a car. Like you have to plan so much further ahead, but at the same time, it's like such an expensive platform. You probably can affordably put like LiDAR and all sorts of other like radar and vision and all sorts of other sensors where it may not make sense economically to do that. On like cars, it would make sense to like sensor up the wazoo your big trucks because they're very expensive. So they're a Safari stock for me, and I think they are a terrible investment right now. So check out their market cap. It's currently, Krzysztof, just shy of $12 billion.
Jeez.
This is a pre-revenue company with unproven technology that ain't doing anything yet. Like they claim they're going to get one truck on the road. $12 billion. Okay, they've got $1 billion in the bank and no material debt, but they've had to dilute shareholders materially to raise that money. And I think there's going to be a ton more dilution down the track. It's on my radar for a future possible investment, but $12 billion for what amounts to maybe a wing and a prayer right now, because they haven't actually done anything just yet. That's too rich for my blood.
Badger, do you know where Tesla's semis and their AI innovation, how they would potentially be an obvious competitor to these guys?
Yeah, totally. They absolutely would. Yeah, but I think Tesla don't have any of those on the roads just yet, right?
Right. But I mean, down the road.
Yeah, totally. Yeah, absolutely. Yeah.
Okay.
Yeah.
For the record, there are 3 million truck drivers. And as far as I understand, the AI stuff that's coming, truck driving is obviously one of the first things. So in terms of employment, 3 million in the US of about 300 million people. That's what, 1% of the workforce right there.
But it's going to be painful when autonomous trucks hit, because once someone solves it, like there are some complexities. Let me go a tiny bit deeper into this Aurora thing, because there is a complexity they've been wrangling with the regulators over. So evidently in the States, I don't know if this is like statewide or just Texas or nationwide or just in certain states, evidently if you have a commercial truck, if the truck breaks down or has some sort of issue, the driver has to get out and like hand place like cones or warning devices around the perimeter of the stuck vehicle so that other drivers can kind of see it and navigate around like this big like roadblock essentially. And if you're a car or a motorcycle, maybe you're encouraged to do that, but you don't have to do that. And so I think Aurora probably quite correctly tried to challenge your driving regulators, whoever they are, on that, but they've failed in that challenge. So what they suggested was, instead of having like these cones, because there's no human being to go and stick the cones out there, that they could have like a series of like flashing warning lights and something really obvious. So it kind of makes sense. I don't know why the regulators push back on that. So yeah, so there are.
But see, even then, when I'm thinking of the Tesla counter case, they could put an Optimus robot in the truck. An Optimus robot comes. I mean, that's a simple task, right? We know that they could do that.
Yeah. I mean, there's probably other solutions, right? You could probably like, it's so dumb, but you could have like drones, or you could just like push these things out on like articulated arms and like put the cones down and then, just have them. So I'm sure it's solvable, but it's just like a bit of like, it's sort of daft to have to engineer your way around that. You're right. Optimus would be like an easy shortcut for that. But that's just one small example of how the regulations probably aren't really keeping pace with like the pace of innovation. But anyway, so it's more complex than cars. But in some ways it's easier, but perhaps because like trucks essentially will drive like the same arteries over and over. Like, you know, what if you solve like Houston to Dallas? Well, that's it. And you could have, you know, a couple of thousand trucks doing that journey continuously. And if you have like a fleet of them, if something's happened, you know, it could be informing the rest of the fleet through the cloud that, you know, there's some obstruction or something. Whereas driverless cars are going in like every different direction, and they have to like, so maybe solving autonomy, it might be in some ways easier for trucks, but harder in that it's probably harder to sort of stop safely because it's such a
Right,
big
yeah.
thing and like park safely, whereas it's easier for your car.
Yeah, and on the autonomy angle, my FSD Tesla is just getting stupidly good now. So, right, to your point, trucks, which basically more or less go up and down, it's a much simpler problem in theory, though it's those edge cases always, of course, that make it the big problem that it is. So, are you buying any shares?
No, definitely not.
You're going all in? Sweet.
And I mean, to be honest, I'm going to talk about a short in a minute, but like, or rather a put option I have bought. Like maybe I should buy puts on this because $12 billion, right? Like the wheels are going to come off that pretty freaking hard, I think, when it goes bad. Maybe I should. In fact, I might do. I'll tell you next week if I do or not.
Okay.
Shall I tell you about a put I did buy though?
Yeah, because I really you need to educate me on a technical detail that obviously I don't quite understand with this, and
Maybe I'm being dumb money here then, because I haven't done a huge amount of research. I got to be in my bonnet about it.
Okay.
So I now own a couple of shorts, or rather, I've bought long dated, deep out of the money puts on American Tower, ticker AMT. Now America, I'm not an expert in American Tower, but essentially it's like a real estate investment trust. They own like a whole bunch of like the cell phone towers across North America, and I guess they must lease them out to like the mobile providers to stick their, you know, sensors on them, and then that creates like the grid, like the sort of cellular network. So, like, if we believe that Starlink and more importantly ASTS are going to deliver like cell phone signal from space over some long period of time, like 10 years time, there'll be a decreasing need for ground-based infrastructure, particularly in like less dense rural areas. So you're always going to want to have like ground-based stuff in like cities, because it doesn't make sense to try and service a city with today's technology from space. There's too many people living on top of each other and too much like bandwidth in one narrow geographic area. But across like some huge, like, I don't know, Iowa or somewhere, then you don't, if you can serve, you know, however million Iowans there are with a couple of satellites rather than a whole ton of ground-based infrastructure, it's going to be cheaper in the long run. So I think AMT's business model is probably going to be in trouble in the long run. So I bought some puts.
The thing that confuses me, I guess, is, and it's embarrassing that I don't know the answer to this question, but I'll probably dig into it after we finish recording, is why is American Tower partners with ASTS if it were to spell their imminent demise? So there must be something complicated about the relationship business model that I don't get.
Well, it's like why, you know, the Saudi Arabians have made huge investments in solar, right? Like you've got to hedge your risks. And so AMT board clearly sees that as a risk. So they want to get some exposure to that thesis themselves because it protects their business model. No?
Yeah, so it seems like it has more to do with some kind of both and model rather than either or.
Mm-hmm.
That the terrestrial stuff is not going to go away. It's just that the space stuff is an augmentation. But so that's actually side note. From my understanding, T-Mobile is the only Starlink affiliated large player, but from the ASTS bulls, they're saying they'll regret that decision because SpaceX in the end is kind of going to be in it for themselves. And, we know Elon's playbook is going to be quite aggressive, and they're probably at some point going to do what's best for themselves. Whereas ASTS has signed up all of these deals that are together with the other mobile network operators. So maybe I'm stuck at seeing what is it that ASTS would do to put American Tower out of business, with American Tower, to reiterate, actually funding them.
Well, again, I suspect they're funding them more for like a hedging or protective thing. But let's just look at their growth. So I'm not saying AMT are going to go out of business and suddenly we don't need any cell phone towers. I'm not saying that at all. But like today, let's assume, right, there are areas, underserved areas in North America, like there are in Britain, where you have very poor cell phone coverage or no cell phone coverage, right? And probably some big highway, like some backwater highway between like two major towns or something. Probably got no cell phone coverage there, and you wait to get to town before your phone starts working. Definitely in Death Valley. I've driven through Death Valley before. Had like no phone signal there. So there's money to be made there if you can provide a signal, but not enough to justify building like ground infrastructure, like a big cell phone tower, and then having to run all the cables and the electricity and everything else. So it wouldn't justify putting that network in place with like traditional technologies. So you've lost some economic value, because there is economic value of like those guys driving through that location, or the few shops that happen to be there, whatever's there. Well, if you have satellite-based communication, you can capture that economic value, right? Because the incremental cost is almost zero to cover like these dead zones that are otherwise inaccessible to ground, or not economically viable for ground-based infrastructure. So like AMT probably already serve such a huge part of the market. Where does their future growth come from if it's like economically unviable to hit some of these smaller locations? So I feel like the growth is going to get slammed. And maybe, they're not a growth company. They're like a mature dividend paying,
right,
like investment trust. But does it at some point then, as this technology gets better, now we're like a few generations down the road, 5 or 10 years time, and maybe satellite-based communication can serve some of the existing like denser towns and areas more effectively, more efficiently, and then maybe like the AT&Ts and these guys say, well, actually, we'll buy our capacity from like ASTS rather than putting like the next Gen 5 whatever mast in the city, because it's cheaper to do that, and actually we can deliver like 5G much cheaper. So at some point, like slowly, the need for these locations is going to wane away.
Okay, I think I have a bearish take on your put.
Go on.
And you said it earlier. If I think of American Tower as a real estate company,
yeah.
So just forget cellular tech stuff. We know that the space stuff is space direct coverage is playing along with terrestrial towers.
Yeah.
Okay. So it's a layer. To go back. It's not an either or. Towers are not going to disappear. The real estate remains valuable. You also said it yourself. It's a sort of slow and steady dividend playing. Yeah. Real estate, they own land, right? Mm-hmm. I don't see why buying a put here is smart, because it could, if nothing else, even if growth slows down a little bit, there's nothing that's going to make the stock dive.
Yeah.
That's what you need in the put.
Yeah.
Is like a catalyst for like the company explodes for some reason.
Yeah.
And so even a growth slowdown, whatever, right? It's still a reasonable investment just for dividend perspective, right? So to me, it's like one of those situations where on the surface it looks like, yeah, I don't think I could justify buying a put on the thesis that growth is going to slow.
Okay, fair enough. This is in my options portfolio, which is my entertainment portfolio. So like I'll often take, a couple of $1,000 here and there just for a laugh, just to kind of see what happens. So I'm sticking with this bet, and it's a deep out of the money, long dated put. So like the stock price probably doesn't have to move too far in my favor for that to start to look quite interesting.
Let's revisit this. I want to see how this plays out.
Yeah. I did this with Duolingo, and I had to like go home with my like broken arms or whatever. So like the Duolingo owl effed me up. So we'll see.
Yeah. Cool. Awesome, Badger. All right.
Awesome, Monkey. Very good. Good chats. So we both use FinChat again in today's episode. We use it every week. The deal may have finished by the time this episode goes out, but if somehow, well, if you're on our Patreon, we definitely told you today, right now, finchat.io/wildlife are offering a 25% discount, much more than the usual 15% discount off of any paid plan. So go check it out, finchat.io/wildlife, to get that excellent discount, and it ain't going to last long. They only do these discounts at most twice a year, sometimes only once a year. So this is your window right now to get that benefit.
Yep, and a shout out to our Patreons. Thanks for everything you do over there. It's a fun ride. Patreon.com/Wall Street Wildlife. Are you ready to become a beast of an investor?
Your journey starts here.
That's the saddest monkey claw I've ever seen. There we go.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.